When Bitcoin first popped up, you might have found yourself unsure with what to make of it. However, great investors like Warren Buffett had a pretty solid take on it right from the start. He said that if someone offered him all the Bitcoin in existence for $25, he would decline the offer since he sees no use for it. What made him say this? And what more can we learn from Buffett's perspective? Stay tuned to find out. Charlie Munger, Buffett's right-hand man, expressed a similar sentiment, stating that he wouldn't accept Bitcoin because he sees no practical use for it. Munger typically avoids getting mixed up in things he sees as dumb or morally wrong, especially if they make him look bad compared to others. He thinks Bitcoin ticks all those boxes. Since early 2018, when they began discussing Bitcoin, the cryptocurrency has surged by 400%, while Berkshire Hathaway, their investment firm, has only seen a 75% increase. This raises the question, if Bitcoin is performing so impressively, why do these two figures, considered paragons of financial world, disapprove of it? Could they be wrong after all? To grasp Bitcoin's concept, you've got to put yourself in the shoes of a 30-year-old American in 2020. Picture the entire country coming to a halt, a rare occurrence to say the least. Well, you already saw it happen, but anyway, here's an example. There's this guy named Ryan. Ryan has lived a responsible life, diligently working since he turned 18 without indulging in parties, travel, or frivolous purchases. He saved $100,000 to secure a home for his family. However, when the pandemic hit, he decided to continue his responsible approach by locking away his money until the situation stabilized, a move traditionally seen as wise. 3 years later, he revisited his savings only to find that the cost of housing had surged by 37%, while fuel prices had doubled. The $100,000 he had worked hard for over 12 years was now worth only $70,000 in real terms. Despite his dedication to hard work, savings, and avoiding risk, Ryan found himself facing what the financial community calls a silent tax. It's a scenario that feels like fiction in an alternate reality, but unfortunately it's not. This highlights significant flaws in what we know as traditional currency. If only there were an alternative solution. Looking back in history, it becomes clearer that this issue isn't anything new. It's persisted for over a century across more than 100 currencies. The dollar has been losing 7–10% of its value annually for a century. This equates to a staggering loss of 99% of its value over the course of a century. The issue lies in holding any currency, as each one carries the risk of loss. This is because they share a common trait. They are all subject to control by central authorities. These authorities intentionally, legally, and discreetly devalue people's money over time. But what if we tell you that there's a currency that's immune to that? The issue doesn't stem from the concept of currency itself, but rather from the individuals who wield control over it. This is commonly referred to as the central bank, or in the case of the USA, the Federal Reserve. However, even the Fed has its own bad habits, and that's printing too much money. This practice devalues the existing currency in circulation. Consequently, everyone's savings held in banks effectively lose value proportionate to the amount printed. This leaves savers at a loss, while those who don't save remain broke. This situation may seem like an unavoidable aspect of our economic system, but there might just be a solution. In January 2009, a mysterious online currency emerged, designed to address the shortcomings of modern currencies. It operates without centralized control, with its power distributed across millions of computers. Even if some computers fall into the wrong hands, there are countless others to safeguard the currency. It also has a fixed maximum supply of 21 million coins, preventing inflation. And unlike gold, this currency can be transferred instantly with the click of a button, offering remarkable flexibility. With such advantages, it's puzzling why these two financial experts just hate it. To understand this, we must delve into Warren Buffett's mindset. In January 2011, Buffett was gearing up for a significant investment. He had his eye on a company that aligned with his investing philosophy, a strategy centered around purchasing stocks at reasonable prices, with cash flow quickly offsetting the investment and yielding returns for years to come. This approach had served him well over the years. He decided to act and acquired 55 million shares of IBM, a stock generating $15 billion in income with a market cap of $200 billion. If successful, this investment would provide him with a steady stream of cash flow. Buffett prefers this method over speculation. investing in something with uncertain returns in the hope of future gains. He views speculation as too risky, prioritizing the protection of shareholders' capital above all else. Therefore, when confronted with a new asset that generates no income, lacks practical use in everyday transactions, and exists solely in the digital realm, Buffett dismisses it entirely from his investment framework. And then there's Charlie Munger. He famously called Bitcoin rat poison. Munger's main argument against Bitcoin is that he views it as inherently evil. While it's understandable how a person, a system, or a cult can be considered evil, labeling a currency as such seems nonsensical at first. However, Mongers Perspective stems from the fact that Bitcoin has become a favored currency among criminals. Indeed, while transactions are recorded on the blockchain, the identities behind these transactions remain unknown. This anonymity facilitates illegal activities, allowing someone to illicitly earn millions without being traced. Bitcoin's greatest strength, the inability for any central authority to control it, also becomes its greatest weakness. The success of Bitcoin differs fundamentally from most assets. While the value of bonds, stocks, or farms isn't solely dependent on how many people want them, Bitcoin's value hinges entirely on demand. This is why Bitcoin owners are vocal about their ownership. They need others to adopt it to drive up the price. The key players they seek to onboard are institutions. The big players like BlackRock, Vanguard, hedge funds, and even governments. Despite the advantages, Bitcoin is far from being the perfect form of currency. According to a study by the Harvard Business Review, Bitcoin consumes approximately 110 terawatt-hours per year, equivalent to 0.55% of global electricity production. Similar to the energy usage of countries like Malaysia or Sweden, this level of energy consumption has significant environmental implications. Additionally, Bitcoin transactions are slow, come with annoying fees, and the currency's value is highly volatile due to its reliance on the free market. The unfortunate reality is that Bitcoin's flaws as a currency may ultimately lead to its demise, as its value could potentially plummet to zero. Well, that's about it for today's video. If you liked today's content, feel free to hit the like button and subscribe to the channel. Thank you so much for watching, and we'll see you on the next one.